You see the asset managers, if they can't communicate their product, they're losing. Nobody's opening their emails, nobody's taking their meetings. I don't think advisors are necessarily picking one product provider to work with. They just don't have the time or the inclination to take every single wholesaler call. It's the people who are going in with, here's what's happening in markets, here's how portfolio allocations should be shifting, and here's how that might impact you. Those are the ones that are winning.
Carolyn Barnette, independent portfolio strategist. Obviously,
Hi.
We've known each other forever, so we'll say that up front. You worked with us back in the beginning at ETF.com as one of our analysts and have had a heck of a career working at BlackRock in the model portfolio space. Now you're doing independent portfolio consulting around this stuff. Let's just start with what a crazy industry this is. You've now been on like a couple different sides of it. What's your sense on where the ETF industry is now and what you think the big challenges are for advisors going forward?
Well, so it's funny because we worked together, 15 years ago? And at the time it was, oh my goodness, there's 50 US large cap ETFs on the market. How are advisors going to sort through them and pick them? All 50. And we built something pretty amazing, this way of going through the universe and helping advisors sort through it. Now there's a lot more than 50. And the question is not just, well, are we looking at the top 50, the top 200, the top 500, the top 1,000, the top 750? There's a lot of ways to define large cap. And now it's not just that. Now it's also, are we slicing and dicing based on factors? Are we looking at active ETFs? Are we doing options overlays? And so it's no longer appropriate to just say, well, how does this methodology impact the fund? You're actually having a lot more crossover of the way you would traditionally evaluate an active manager and the way you would traditionally evaluate an ETF. Those are becoming pretty close to one and the same with some small differences.
So you looked at, I'm going to guess at this point, thousands of advisor portfolios over the years. What do you see as some of the most common mistakes or the common sort of stumbling blocks advisors hit when they're looking at an ETF portfolio and trying to sort of consolidate? I see that with advisors a lot. They get a new client in, it's got 1,000 line items on it. They're trying to get that down to a rational portfolio, whether they have their own model or not. What are the stumbling blocks?
Yeah, I mean, one of them is the same it's been for 15 years, which is you pick a large cap fund that you like, a mid cap fund you like, a small cap fund that you like, and what you actually have is a ton of mid cap exposures because they all overlap in different ways. I think other mistakes people make is they don't necessarily think about it on an after-tax return basis. Some of these strategies, depending on how often they're rebalancing, how they realize gains, how they pass through gains, 15 years ago, ETF was basically synonymous with no capital gains distributions. That is no longer the case. Some of the ways of structuring it, depending on how they create redeem, depending on what sort of vehicles they use, completely different. And so I think you do get some surprises there. Other mistakes I see a lot, people not matching up the objective of what they're trying to solve for. And just sorting for returns rather than sorting for risk, correlation, et cetera. I mean, you see this in bond portfolios all the time. All the people that sort high to low on bond strategies and then are surprised that their stocks and bonds nosedive at the same time because they've loaded up on credit. You see this all the time in the alternative space as well, where people, if there's anything advisors that I've worked with have loved to complain about, it's their alternatives not working because they've either picked strategies that are meaningfully underperforming when the stock market is going up, or meaningfully underperforming when the stock market is going down. They're not providing what they want. And so I've talked to a lot of advisors about starting with, what do you actually need this fund to do? And then going to, does it actually do it? Are the returns what you expect? Are the returns through different regimes what you expect? And is the risk budget reasonable?
So my friend Brian Portnoy has this great phrase, which is diversification means always having to say you're sorry. I mean, that's sort of what you're talking about, is that if you're actually creating a holistic, diversified portfolio of ETFs, you're including things like alternatives. You might be including things like gold. You might be including things like other edges of the credit spectrum rather than just the ag. So how do advisors tease some of those things apart? Like if they're complaining about their alt exposure, is the problem that they don't understand their alt exposure or that the alt exposures that are available are just too confusing?
I think it's a mix. And I've heard that same idea as, look, if none of the line items in your portfolio are down, you're not doing a very good job of diversifying. Yeah, I mean, I do think a lot of it is chasing the hot dot. And the latest example is private credit, right? Everybody was so excited about private credit. You can get 10 to 12% yield for free. Not a lot of people looked below the surface. Not a lot of people thought about, well, do I actually want this in a tax-sensitive portfolio? I mean, we're here we're all talking about after-tax portfolio construction. And so I think that's another mistake. Yeah, I mean, I think a lot of them are complicated and it's really easy. Everybody's busy. They're being pulled in a lot of different directions. You see a strategy that has really strong returns, is going up and up and up. I don't know that very many people even have the tools, not to mention the time and the inclination to really dive into, well, why? What is driving those returns? When does it do well? When does it not do well? And so that can be really hard to do. And so some people have just said, well, I don't want to do it. I'm out of that space. And I think they're missing out on a lot right now as well, because we've been in an environment that has been difficult for traditional bonds. And so you kind of went from everybody's always fighting the last war. And so the last war was, oh, my alternatives are black boxes. They blew me up. I don't want them.
Right.
The new war is, why are my bonds losing money? My stocks are losing money. I don't want that. And I'm not one who believes that bonds are broken. And I think people are massively underappreciating the fact that most systems report bond returns on a price return basis rather than total return basis. So you look like you've lost money even if you're actually up through your income.
Right. Much less on a after-tax basis, which is how
yeah.
we should all be really evaluating. That's been the lesson here for me at Basis Northwest is everything is a tax decision, right? I mean, unless your entire job is just managing people's 401ks and IRAs, everything's a tax decision, which really gets complicated, right? Because now you have to think about each individual client's tax persona, where they're domiciled. Have you picked up any tidbits here while we've been here that have surprised you around that tax-aware investing strategy?
The biggest surprise to me is that 351 exchanges can now be implemented at $150,000 minimum. I mean,
That's huge.
is just,
yeah.
It's huge. You think about all of the advisors out there who everybody has some low cost basis securities on their book. You think about all of the advisors who want to shift into model portfolios, need that scale, but they can't because it's not right for their clients.
Because they're trapped in low basis stocks or low basis funds.
Even low basis funds. You bought SPY 10 years ago and QQQ 10 years ago, and you don't really want that much QQQ, but you've got it. I think the 351 exchange is a really neat way at scale for advisors to say, well, I actually just want 25% of the portfolio in an S&P 500 like strategy. Let's get all of this junk over, do a one-time 351 exchange, and then you've got that. I think that's massively underappreciated because I would have thought before yesterday that the minimum would have been much, much higher.
Well, and they certainly were. I mean, the challenge then becomes if you're 351 exchanging out a bunch of your equity portfolio, for the most part, and this is probably an overgeneralization, most of the resultant funds from those 351s are pretty boring, right? They mostly look like well-diversified large cap data.
Yeah.
That means that if you're in the advisor seat and you're now building portfolios around those, that kind of becomes a fixed point in the optimization because you're not gonna then go sell that and buy your sector rotation strategy. You're kind of stuck with this beta strategy. At the same time, I hear a lot of advisors talking about wanting to really reduce the number of firms they're working with. Yeah. So if you've used a firm for this 351, how do you think about then augmenting that with, say, your international exposure or a sector tilt or a factor tilt? Is that a mistake for advisors to want to be sticking with one or two providers, or should they actually be broadening out and really picking a best-in-class provider for each individual slice of the portfolio?
On the 351, boring beta has been really, really good to own over the past few years. And so active managers love to shout about how the indexes are broken and, oh, they're so concentrated. That has actually been a benefit, not a problem.
Right.
And I think we're both believers in efficient markets. And so I don't mind having that. In terms of how many partners should you work with, so yes, is it best case to have the best fund you can in each slice of the portfolio? Absolutely. I don't think advisors are necessarily picking one product provider to work with. They're picking one partner to work with. Maybe one, maybe two, max three. But where they're really leaning in is what should my asset allocation be? The really big firms have their own asset allocators. The smaller firms, and they're not even that small, you think of maybe even $1 billion advisory team, doesn't have necessarily their own CIO. Having the partner to give them the sense of, okay, markets are shifting. Are we going large? Are we going small? Should we lean into value or momentum? I think that's where you get the sticking with one partner. And they just don't have the time or the inclination to take every single wholesaler call that comes in. They can't. And so I think the winners, for better or for worse, are going to be the ones that can go anywhere and so can provide that cross asset class perspective versus that, hey, I've got a really good high yield bond fund. Can we talk about it?
Tough. Yeah. And you talk about sort of picking your thought leadership partners more than picking your product partners. I think that's a really interesting framework, especially as we're talking about things like more complex tax strategies and alternatives, because I think it's unreasonable for most advisory firms to have an expert on managed futures in-house any more than they would have an expert on high yield credit in-house. Yet those should be part of the conversation. In your seat, how important is the communications part of that? Because there's the helping build the portfolios part of it, but then there's the making it make sense to the client part of it.
The communication is everything. You see it. You see the asset managers who, if they can't communicate their product, even if they're just stuck in that world of, we've got 5 stars, we've got 500,000 years of combined investment experience on our team, they're losing. Nobody's opening their emails. Nobody's taking their meetings. It's the people who are going in with, here's what's happening in markets. Here's how portfolio allocations should be shifting. And here's how that might impact you. Those are the ones that are winning. I'm not seeing a lot of people want to dive really deep into the weeds of how products work. It's more about, and I think this is a good screening mechanism, by the way, it's, do I even need this allocation first? If you don't need the allocation, you don't need to waste your time doing due diligence on any of the products. But I think in the old world, you start with oh, that's a really interesting product. How do I fit it in? When it should actually be, what's the allocation I want? And so, yeah, the communication of why this product, why now, how does it fit in? How do you size it? How do you fund it? How do you scale it across your models is incredibly important. And I do believe that that's why the asset managers who've been drawing in more assets have been winning.
Makes sense. Well, thanks so much, Carolyn. Good to see you.
Thank you.